Hello, welcome to this video on government measures to improve international competitiveness. So in this video we're going to look at a range of different measures the government may introduce to improve the international competitiveness of its businesses. So we've said previously that competitiveness is usually measured through price or quality. And price is influenced by the cost of manufacture, and there are a range of factors that will influence this, and the exchange rate. And again, there are a range of factors that will influence this. Now, any government policy will affect any of the factors above, can have an impact ultimately, therefore, on the competitiveness of businesses in that country. So, for example, if the government were to change the rate of taxation, this would have an impact on the competitiveness of those countries. If the government was to engage in a fixed exchange rate scheme, this would have an impact on the competitiveness. If governments were to alter the level of education and training, then again this would have an impact on competitiveness. So any of these items we can see here, any government policy that will affect them can have an impact on competitiveness. So more specifically, when we're talking about government policies, we're really talking about primarily supply side and fiscal policies that will have an impact on businesses within that country and their ability to sell their products successfully overseas. So what might be some examples? Well, there are lots of examples, so let's take down some notes. For example, changing rates of taxation. Cutting corporation tax may allow businesses to reinvest more money into new technology. Lowering income tax may provide more of an incentive for people to join the workforce, which may attract better quality of staff, helping businesses to improve the quality of their products, for example. Indirect taxes have an impact on prices and costs of raw materials, and some businesses may receive tax breaks from the government, which again may increase their profits, make them more, or allow them to charge lower prices and make them more competitive. There are lots of things the government may do with the labour market to make it more competitive for businesses. Maybe changing employment law, for example, making it easier to dismiss staff. The introduction of a minimum wage. Investment in education and training. Altering the incentive to work, increasing the incentive to work may provide more employees, lowering wage costs, or maybe providing better quality employees. Limits on trade union activity may be something that the government may introduce. The government may also have policies on infrastructure, maybe improving transportation, so through new railway links or ports or roads. This might lower costs of transportation for businesses and the cost of manufacture. Providing networks such as broadband, for example, this may again make businesses more competitive. We can continue. Exchange rate. If the government was to fix the value at a low rate, we must be thinking WIPODEC, a low relative exchange rate, is going to reduce the price of our goods abroad, make businesses more competitive. In terms of product markets, stripping away some regulations, maybe making businesses have to comply less with certain regulations, so they can be free to offer a wide range of services or spend less costs complying with regulations. Governments may provide subsidies, they may fund research and development. Governments may privatise public industries, and through the privatisation they become more efficient and able to charge lower prices and therefore able to become more competitive internationally. Governments may think about introducing industry standards to drive up quality, or reducing industry standards to lower costs. Governments may also have an impact on finance through their setting of interest rates, but maybe also more directly by providing small loans or grants to particular businesses. Lastly, governments can provide or monitor the overall macroeconomic environment in which businesses operate. For example, controlling inflation can keep businesses' costs lower, which enables them to have lower prices and be internationally more competitive. So there really is a wide range of policies that governments can use, and we have to be able to recommend suitable policies given the example that we're talking about, given the context and the situation that we're looking at. So we're going to look at a number of policies now in a bit of detail. What I would suggest is taking a screenshot of these policies and then printing them out and sticking them in your notes. So this first policy is called devaluation, and there's a bit of detail here, but essentially what the government does is it lowers the value of its currency against other currencies by intervening in the foreign exchange market. This has the impact of Whipperdeck essentially. A weaker pound make imports more expensive, but crucially exports cheaper. So businesses in a country that has devalued its currency will have an advantage internationally through lower prices. However, we have to balance that out with the fact that imports will go up in price, and therefore any product that requires a lot of imports, the cost of those imports will increase. The next one is deregulation. So this is an example of a supply side policy, removing some of the red tape, the rules and restrictions that businesses face. And this can allow them to be more creative perhaps in the range of products that they offer, but also it can substantially lower the cost base that businesses have to comply with, which can have an impact for cost of manufacture and for price. In terms of infrastructure, governments might invest in factories, office roads, ports, broadband networks, and so on. We can see that through our diagram on the bottom here, our ADS diagram. A successful supply side policy is likely to lower the price level in the economy. So if price inflation is depressed, you have lower inflation or lower prices, this is going to make the international competitiveness of those products better. Education and training is our final example. So increasing levels of education and training will raise the marginal revenue product of workers, so i.e. the value of output of hiring extra workers. So this effectively lowers the costs of production because those workers are more efficient. You can get an increase in production with less of those workers if they're more productive. And so reduces costs for businesses. It may also have an impact on quality. Better trained staff, better educated staff may produce better quality products. And this will help businesses in terms of their international competitiveness. An important trend for us to recognize when we're looking at competitiveness, price and quality and cost, and assessing all these things, is that looking over time, we've really seen a convergence between developed economies and developing. So here we have a chart showing the advanced economies in the USA, and they are the dotted lines at the top. And we can see there's a general trend here where their competitiveness has been fairly flat, if anything slightly downward trend. This is based on the World Economic Forum's competitiveness rankings. Whereas if we look at China in particular and the emerging developing economies, their line of best fit is really an increase in terms of competitiveness. So what we're seeing in the modern economy is we're seeing really a convergence in terms of competitiveness between developing and developed economies. So that's an important trend. Let's make a little note on that. So in this video we've looked at a range of measures governments may introduce to improve international competitiveness and the closing of the gap of international competitiveness between developing and developed countries. That's it. Thanks very much for listening.